What's up, everyone? It's Karthik with MoneyVest. So get ready for yet another incredible week in the markets. 2024 is coming in to a close. We only have 2 more trading days left in 2024. And Wednesday, the markets are actually going to be closed in observance of New Year's Day. And then, of course, 2025 is going to get started on Thursday with yet another. There's a lot of expectations with yet another blockbuster year in front of us, with Tom Lee also talking about the first 6 months being a lot better than the second half of 2025. Of course, time will tell, but in this video, I'm going to break down a lot of statistics related to the valuation, a new RSI dashboard that we have created on the MoneyVest platform, and a lot of really interesting statistics that will help you in your decision making for the next year. So hope you all enjoy this video and find it helpful. Make sure that you drop a like, and also do me a favor, share this video with your friends and family, other traders and investors, so we can have more people join us and have a very lively discussion recapping 2024 and of course getting started on the New Year's as well. So far, December seasonality has been very poor. The markets are down a little bit over 1%, so S&P 500 certainly selling off quite a bit in the month of December. We were still up on the week. We were down on the day, and we are down on the month so far in December as well, with only 2 more trading days left. We'll see if the markets can flip this around. But as of right now, this is the 3rd negative month in 2024 for S&P 500, despite December having such a strong seasonality with over a 70% probability that we're going to be green by an average of about 75 basis points to as much as over 1%. The markets are certainly not playing their part in pushing higher. Of course, November was the best month of 2024, up almost 6%. It was absolutely incredible momentum on the back of what's known to be now Batman stocks. So Batman is going to be your Broadcom, Apple, Tesla, Meta, Microsoft, Amazon, Alphabet, and Nvidia. And these are the Batman stocks that have obviously catapulted the markets to propel new all-time highs here, just absolutely getting crushed, in the markets, of course, in terms of a lot of liquidity, a lot of market cap increase, and again, trading all-time highs. So that, of course, has resulted in a lot of momentum to the upside, but December, of course, has been very weak on the back of the monetary policy, the Federal Reserve, and what Jerome Powell has penciled in, what the FOMC members have penciled in for the summary of economic projections for next year. Now, unemployment numbers don't come out next week, which again is a little bit odd because they usually come out on the first Friday of every month. But for this particular December report, they're actually going to be coming out on January 10th. So we actually don't have any unemployment numbers scheduled to come out for next week. So if you come over to the medium and high impact items for the upcoming week, Wednesday, there's nothing. The markets are going to be closed. Thursday and Friday, we have some ISM manufacturing numbers, some MBA 30-year mortgage rates, and some gasoline numbers. And then on Monday and Tuesday, we've got Chicago PMI, the S&P Case-Shiller Home Price Index, crude oil stock. So that's about it. And then from an earnings standpoint, we don't really have any notable earnings that are coming out next week. So it's going to be a pretty light week from an earnings and economic calendar standpoint, but I'm sure it's going to be a very volatile week because we're just rolling over from 2024 to 2025. Now, there are a few different things I want to discuss in this video. The first one being exactly this statistic, as I mentioned in my last update. So far, the markets are up over 25% this year in 2024. Last year, the S&P was up 26%. So when we see 2 consecutive back-to-back 25% plus years for the S&P 500, the following year, which is year number 3, which is going to be 2025, for us to see over a 66% probability that we're going to be green by an average of about 6.2%. So if the markets are up over 25%, more than 25% for 2 consecutive years, the probability is slightly higher at over 71% that year number 3 is also going to be positive, because that momentum carries us forward by only an average of 2.5%. So either way, I think the probability is still in the favor of the bulls to keep this momentum higher. But there's definitely going to be a lot of other factors also involved with the new president coming into the office, monetary policy, the Federal Reserve playing a very, very dangerous game with interest rates and unemployment, which I'll go over in just a minute. But from a purely seasonality and historical analysis standpoint, the probability is still strong for the bulls to keep this momentum going. into 2025 with an average gain of about 6.2% to as much as 2.5% respectively, depending on how much we are up for this year, where we close for the next 2 trading days. Now, this right here is the valuation for S&P 500. And so what I've done here, as you already know, I've shared this in my previous updates as well. I've taken into account both the S&P 500's change as well as the earnings per share for the S&P 500 companies. And right now we're up just under 26%, as I said earlier. And the earnings per share pegged at $245, $250 is going to be just under a 10% increase for EPS for these 500 plus companies. And so if you take a look at where we are from a valuation perspective, we're sitting at just over 24.5, which right now puts us actually at the 93rd percentile, going back as far as 1960. So very simply put, you take a look at all the valuations the S&P 500 traded at in the last 50 plus years or 60 plus years. We're going back as far as 1960. The valuation that it's trading at today at 24.5 is in the 93rd percentile of all those valuations, meaning that it is trading so high that 93% of all values fall below the 24.5 level where it's trading at the moment. That just goes to show that yes, the markets are indeed expensive right now given the valuation for this market. And if you compare this to the 5-year, 10-year, 20-year, and 30-year averages, you can see the current average and how much it is over and above its historical averages. So in other words, 5-year average, it's about 11 to 12% over its 5-year average. On a 10-year basis, it's a little bit more, 15 to 15.5%. 20-year, we're talking 23 to 24% because the 20-year average for S&P 500 valuations has been roughly around 17 to 18 times. And on a 30-year basis, once again, we're 19 to 23% expensive based on today's valuation compared to its 30-year average. So hope that gives you a little bit of perspective on where we are from a valuation perspective. And if you reciprocal these numbers, you're going to get a good earnings yield, and you got to compare that to where the 10-year treasuries are also sitting at. And one last thing I want to break down is the current state of the economy. So this is our recession indicators to better understand how strong or not so strong the current economic conditions are, and whether we can expect any type of a recessionary environment or if this is just a lot of noise. So if you take into account some of the really important data points, right? So what I've done here is I've essentially compiled all the main important indicators to better understand the state of the economy. The CPI headline 2.7%. You could argue that yes, this is above the Fed's target, but on a more long-term basis, 2.7, 2.5% are still pretty normal readings because that's pretty moderate inflation. PCE is the same year over year at 2.5, so both of them are normal readings. But you've got core, which obviously when you exclude for food and energy, sitting at 3.3 and 2.8% respectively. When you look at core CPI and core PCE. So those are, a little bit more on the milder side. They're not hot. They're not above 4 or 5%. So they're not hot, but they are mild, sitting well over 3 to 2.8% respectively. The GDP growth, very strong, 2.8%. Consumption expenditures, 2.7%. Very strong. Retail sales, 3.8% growth this year on a year-over-year basis. Very strong. Unemployment rate sitting at 4.2%. Very strong. Initial claims at 219,000, still really low. And then continued claims growth only at 2.5%. Still pretty normal for the economy. So everything in green is very strong, very low, very normal functioning in the economy. But there are a few things that are weak or weakening. So you've got unemployment growth, 20%. That is on a year-over-year basis. The number of people that were unemployed back in December 2023 versus how many we have now, 20% increase. So that again just goes to show there are more people that are now unemployed than a year ago, right? That speaks volume to how much the higher interest rates have played a big role in hiring and firing from companies and just the number of people that are unemployed in the economy. So JOLTS to unemployed persons have also pushed down to 0.9. So there is less than one job available for every unemployed persons, or I think it's close to one. So again, relatively weak right now, which is also one of the early signs of a weakening labor market, something that we have to definitely keep in mind moving forward. Personal savings rate, 4.4%, which again is a little bit of an improvement from 2.9 to 4.4%. Maybe people are saving just a little bit more, but it's still really, really low, considering the delinquency rates are also increasing to 3.23%, so relatively weak. Services PMI, 52.1%. In fact, I can actually put this back in the green considering that it's back over 50%. So it's going to be a little bit more on the stronger side, but manufacturing PMI is still under 50%, so that's weak, and loan growth is just over 1%, very low because of the tighter credit conditions, considering that interest rates are still pretty high in the economy. So all in all, I mean, I would put this economy as a pretty decent and good functioning sort of economy right now, and we're not really seeing any signs, especially not in the early stages, that the economy might be going through a very tough time or a recessionary environment. I know there's a lot of speculation and a lot of debate for the uninversion of the yield curve that it's going to put us into a recession, but that's just one of the many indicators that we need to keep track of to better understand the health of the economy. One more thing I want to mention is that if you want to join our Discord and our Patreon, links going to be down below. There is up to a 25% discount on an annual basis, and that will give you access to everything, including the MoneyVest website, all the trade alerts, members only videos, options portfolio updates, as well as long-term portfolio updates, and you can pretty much access everything that our community has to offer for an entire year at a 25% discounted rate. So links going to be down below. This does expire in the next 2 days. So after the New Year's, this discount is going to go away. So links going to be down below if you are interested in joining. And you can also alternatively gift memberships to your friends and family as well using this button right here that says gift a membership. So again, links going to be down below. Now coming back over to the markets, volatility here sitting at just over 15.9, a little bit under 16, so just over 8% higher. Keep a close eye on the VIX as we already have been tracking the MoneyVest index, so 3.06. And I also want to go over one more brand new feature that we've added, which is called the SPY RSI dashboard. And this essentially tells you the RSI reading for the S&P 500, but not just that, it also tells you the percentile that it's currently trading at. So for example, we're in the 28th percentile of all S&P 500 readings, which is a pretty normal reading, so to speak, for the current market S&P 500's RSI. Of course, if it gets down to as low as 20 or 10, or we're talking, let's say, 16 or 17, 16 or 19, now we're coming down to the 0.1 to 0.01 percentile, which again is going to be a very, very rare circumstance. The markets are most likely going to be very oversold at that price, very discounted, very cheap. So again, these are just very high quality indicators that we've put together on our platform to better understand the overall risk reward in the market. 3.06 is the MoneyVest index value. We got the buy trigger on December 18, then the market's pushed up again. We're starting to roll over once again a little bit back down to the neutral zone. And if the lower it gets down to, the better the buying opportunity, the better the risk reward is going to be in the markets moving forward. So coming over to S&P 500, as we have already discussed in our previous updates, keep a close eye at that support at 58.67, 58.65, around these levels. So this right here, very, very important level of support. And we've got a resistance that's going to be sitting right about here for S&P 500. A lot of selling pressure on Friday. And this could be very well a potential head and shoulders pattern. We certainly have printed a lower high for the market, so that is a lot of weakness right there. And the Nasdaq, of course, getting tagged at this higher low. Another support level is going to stay put inside this green rectangle, and of course a resistance all the way up to as much as 20,000. Now very quickly, I'm going to go over Tesla, Palantir, SOFI, some of these very, very popular and trending names. For Palantir, we sold off almost 4%. This right here is going to be a resistance to watch for Palantir stock, and if we do continue to see some selling pressure, first level of support is going to be this higher low. It's going to be sitting roughly at around $76, $77. In case we see a bigger breakdown, a much stronger area of support is going to stay put right here at $70. That's exactly where it's getting bought up in the past. Coming over to SOFI, a lot of consolidation for SOFI, so it's been trading sideways. Resistance is going to be staying put at $17, with a support level staying put at $14.87, closer to $15. And if it does, for whatever reason, starts to, let's say, break down from this level, next target is going to be at $13 for SOFI as well. But a very, very strong area of resistance right there at $17.21, and a very strong support right here at $14.87. And finally, coming over to Tesla, and Tesla also just been consolidating sideways in that range. Very strong area of support right there. Resistance staying put at $4.85, $4.89. We also got the delivery numbers coming out for Tesla, so make sure that you do check out that video for this company as well. But right now we're watching that support at $4.15, $4.16, which of course has been a previous area of resistance for Tesla as well. So hope you all enjoyed this video and a complete update on the market. Seasonality wise, I think we are pretty much a coin flip going into this, towards the end of December, early January. We're a little bit of a coin flip whether the markets are going to be up or down, but I'm here to really pinpoint some of the higher quality signals for all of us so that we can actually take advantage of the risk and reward the markets are giving us. And for that, we have to, once again, look at the Money Vest Index, look at volatility, look at the RSI readings in the market and how we're doing. So there's a lot that goes into conducting a full proper analysis of the risk reward in the markets that's present. So hope you all enjoyed this video, found it helpful. Make sure that you drop a like and subscribe to the channel if you haven't already. Also, don't forget, join our Discord and Patreon. I've included the subscription billing so you won't get charged on the first again. 25% discount that's available on an annual basis if you do sign up in the next couple of days. Links going to be down below. As always, happy investing, and I'll see you all in the next video.